Retirement accounts are long-term vehicles, but eventually, every investor faces the same question: how and when to take the money out. The rules governing distributions are among the most detailed in the tax code, and on the Series 7, they're tested not just for accuracy, but for understanding. Every qualified retirement plan shares a common feature: tax deferral. That means the money grows without taxation until it's withdrawn. But the IRS won't wait forever. To balance the benefit, the government sets conditions for when funds can be accessed and when they must be. Withdrawals before age 59 and a half are generally subject to a 10% penalty on top of regular income tax. There are exceptions: disability, death, medical expenses exceeding a set percentage of adjusted gross income, first-time home purchases up to $10,000, or higher education expenses. In employer plans, separation from service after age 55 also avoids the penalty. Once the account owner reaches age 72, required minimum distributions must begin. The RMD is calculated by dividing the previous year's ending balance by a life expectancy factor published by the IRS. Failure to take an RMD results in a penalty equal to 50% of the amount that should have been withdrawn. There's a difference between how IRAs and employer plans handle these withdrawals. For IRAs, the owner must begin by April 1st of the year following the year they turn 72. For employer plans, if the participant is still working and doesn't own more than 5% of the company, distributions can be delayed until retirement. Roth IRAs stand apart. They have no required minimum distributions during the owner's lifetime. That makes them ideal for those who want to leave assets to heirs or allow continued compounding without interruption. For inherited accounts, the rules depend on the relationship to the original owner. A surviving spouse can roll the assets into their own IRA or remain a beneficiary and delay distributions until the deceased would have reached 72. Non-spouse beneficiaries, however, must withdraw the entire balance within 10 years unless they qualify as eligible designated beneficiaries, such as minor children or disabled individuals. When funds move between plans, how that transfer happens matters. A direct rollover, where funds move from one trustee to another, is not taxable and avoids mandatory withholding. An indirect rollover, where the check is made payable to the individual, requires redeposit into a qualified account within 60 days. 10% of the distribution is withheld for taxes, and if it's not replaced, that portion becomes taxable. For IRAs, only one rollover is permitted per 12-month period, regardless of how many accounts exist. Direct trustee-to-trustee transfers are unlimited and are not counted toward that rule. Understanding what happens when money moves or comes out of these plans isn't just test material, it's real-world financial literacy. Take an example. Suppose an investor leaves a job at age 60 and receives a $100,000 distribution from their 401k. If they deposit that money directly into a new IRA within 60 days, the transaction is tax-free. If they take possession of the funds first, the employer withholds 10% or $10,000, and the investor must replace that amount from personal funds to complete a full rollover. If they fail to redeposit the money within 60 days, the entire amount becomes taxable as income. Another example involves required distributions. An investor with a $500,000 IRA at the end of the previous year and an IRS factor of 25.6 must withdraw approximately $19,500 to satisfy their RMD. If they withdraw less, half of the shortfall is owed as a penalty. From a suitability standpoint, these distribution rules shape how investors approach retirement income. Investors who expect higher taxes in the future may favor Roth contributions today. Those who need deductions now may favor traditional plans. Retirees who rely on distributions for living expenses must manage timing carefully to avoid penalties while maintaining stable cash flow. On the Series 7, the key is to remember that retirement accounts are built on two dimensions: tax timing and control. When you defer tax, you surrender access until a specific age. When you pay tax up front, you buy flexibility later. These rules may feel technical, but at their core, they're about fairness, the government granting tax advantages to encourage saving, but ensuring that those benefits eventually feed back into the system. Every time an investor rolls over a plan, takes a distribution, or passes an account to a beneficiary, those rules determine how much of that lifetime of saving actually becomes spendable income. The test asks about percentages, ages, penalties, and timelines. But what it's really asking is whether you understand why those numbers exist to balance private growth with public policy and to make the promise of retirement something that works for both the individual and the economy.